Now, there's certainly a lot of volatility in markets at the moment, in the macro backdrop and within the corporate world. And you can sometimes get sort of lost in the noise a little bit sometimes. I mean, even today, for example, the Fed minutes came out this morning and they were talking about having a slightly more hawkish tone to and even some of the voters talking about potential hikes, which goes completely against the previous rhetoric. So I think sometimes you can't be taken by the short-term noise. You've got to look at the longer-term fundamentals and have a clear view of what's going to transpire over an investment horizon. Probably you don't want to look much further out than, say, 12 months to have a degree of certainty exactly of what's going to transpire. But you certainly don't want to be flip-flopping on every sort of news or data point that comes out. I think generally there's a longer-term trend. I mean, even with the recent US shutdown, which made data very hard to come by, you still had to have an idea of the direction of travel and what central banks want to achieve, where inflation is going. So those are the key drivers to what underlying fixed income markets are going to behave and how they're going to be driven. So that's a slightly longer term trend. So don't get lost necessarily in the short term volatility. Yeah, no, I think we obviously had a very strong year last year in fixed income. So that was really characterised by credit spreads tightening quite sharply to very tight levels, and also yield curves steepening quite dramatically. And that was really driven by two things. Bank rate or interest rates were cut relatively aggressively. The Fed started again its easing cycle, but also the long ends of the curve started to respond to some of the sort of fiscal concerns about country spending. Mainly, you saw that with Germany with the announcement of the defence spend and infrastructure spend. So in that environment, you saw good return from credit, a good return at the short end of curves, and maybe more concern with the longer duration aspect of the portfolio of fixed income markets. I think this year will be slightly different. We're unlikely to see any significant spread compression from here within credit. But the all-in yield is quite attractive in the asset class, and it has meant that investors have actually flooded back to fixed income in general. So I think this year, though, is probably a year that's more going to be characterised by sort of getting the coupon, getting the carry from fixed income. So the yield to maturity that you currently see on some of the fixed income asset classes won't be too far away potentially from the end of year sort of investment return that you get from the asset class. There'll be volatility along the way, but I think that's not a bad place to sort of anchor your expectations as to what you'll actually receive. Yeah, I think you've got to look at that in two ways really. So the risk to the credit spread element of the fixed income market, I think that could be potentially upset by some kind of equity-related, AI-related meltdown or episode. So if we saw the bubble bursting in AI, not saying there is a bubble there, but let's say that those rich valuations suddenly saw a reversal and you lost this risk-on attitude that we're seeing from investors at the moment, that could potentially upset the credit spread angle. And as credit spreads are quite tight, they could snap back to much wider levels. And on the flip side of that, you need to think about the duration story. We've already seen yield curve steepen in 2025, as I mentioned. If we saw a return of inflation, that could be something that inflation is like kryptonite to bond markets, as we know. So it's not our central case that inflation comes back aggressively. If anything, we think inflation is probably under control, particularly in emerging markets and in Europe. Question mark over how quickly the US comes down to target, if at all. But inflation doesn't seem to be on anyone's radar at the moment as a concern. But that's the one big risk that can undermine any fixed income strategy. But I think the bit that probably absent of that or away from that is probably the long end of yield curves at the moment. They've steepened quite considerably. I think a lot of the volatility or the potential volatility and concern is probably already priced in. But we could see whether it's geopolitics or whether it's more fiscal spend, or I guess that's much more vulnerable to potential further increases in the long end of yield curves. Maybe it's an issuance-led dynamic that comes through. Yeah, no, the US is probably the region that obviously gets the most headlines, it gets the most focus because it's the dominant bond market and the dominant economy. I think with the US, it's probably an area where we have probably the least amount of clear signposting as to what's going to happen, because we've got the change of Fed chairman coming up, as you mentioned, Kevin Walsh coming in. Is he going to be, everyone's thinking he's going to be a sensible pair of hands. I think that's a good thing. He's going to maybe maintain the Fed's independence. Theoretically, looking at his history, he seems to be potentially a bit hawkish. So that's how the market seems to have taken his appointment. So it'll be interesting to see how exactly he acts once he's in the role. I mean, I think everyone's pricing in 2 further cuts in the second half of this year, which is something that we agree with. But some of the other data points around the US story are a little bit more opaque and quite difficult to fully understand. Hence, given the Fed minutes we saw this morning, when they're suddenly saying inflation is a potential concern. I think inflation is an interesting one because we're not really seeing a lot of the tariff potential inflation coming through. Goods price inflation has ticked up, but it's still relatively subdued. It's coming from a sort of deflationary or disinflationary angle. So that picture isn't quite clear yet. Will it really, will that inflationary impulse really be reflected in CPI going forwards, or core PCE as the Fed focuses upon? So there's a bit of a question mark. I think that's an area where I think there's less or a smaller degree of certainty as to exactly what's going to happen. Compare that to, say, the ECB, which is just on hold for the rest of the year, and it's even in the UK with our political issues, it's probably a little bit more easy to predict than, say, the US is at the moment. So, and I think one thing as well, I think the market in the past has had some periods of disappointment where the cuts that are priced into the market haven't materialised, and that's actually led to some pretty volatile snapbacks. So if those 2 cuts weren't delivered by the end of 2026, I think that could have some impact on volatility on other parts of the fixed income complex. I think for a conservative investor, where you don't want to introduce too much risk, it probably makes sense, we think, to look at the shorter end of shorter end of corporate yield curves. So the sort of 1 to 5 year space is probably an area of the yield curve that we particularly like in credit. Mainly sort of IG, but with selective high yield issuance from a sort of active perspective. But if you're thinking just pure indices, then the short dated credit part of the market looks relatively attractive. You've got a nice sort of roll down effect now with slightly steeper curves in the US and in the UK. Not so much in US yet, but once those cuts come through, you'll have an upward sloping front end of the curve. So it gives you that nice carry and roll down effect. And also being that shorter maturity sort of profile gives you a bit more clarity over the corporate risk you're taking, the credit spread risk that you're taking, and more confidence that those bonds are going to be good to maturity and pay you back when they redeem. So I think for the cautious investor, that is probably where I would say I would recommend they look at, because what you're trying to do at the moment, particularly for a European investor, where bank rate is only 2%, any return above that or increment above that could be quite attractive. So you can get a good pickup over 2% cash just by playing in that 5 year space. And also you don't have too much duration sensitivity there. I mean, duration sensitivity is something that can be very volatile, can be very damaging. We saw that in 2022. So I would not, particularly with the long end of curves being a little bit potentially under pressure, I would not recommend, to a cautious investor anyway, moving out past the sort of 7 to 10 year part of the yield curve. Yes, they did. And I think we're very constructive on emerging market debt at the moment. We think it's an area that's going to potentially get some good structural and fundamental tailwinds to support the case for EMD. I think when you're looking at EMD in general, or actually fixed income in general, you've got to make sure you're getting rewarded amply, you're getting well rewarded for the risk that you take. So I think in the current environment where spreads are tight, all risk assets around the world, equities, etc., look pretty richly valued, there is the opportunity to be disappointed if something goes wrong. So you've got to take a cautious approach, we think, at the moment, and look at the world through a sort of a unit of risk perspective. So how much risk are you willing to take, and how much reward will you get for taking that risk? Now you can look at this through maybe an indice level, through Sharpe ratios, how much excess return you can get above the risk-free rate divided by the volatility, or you can look at information ratios with an active manager, for example. So it's really looking for those sweet spots of return. So I think the 1 to 5 year part of the credit market is one sweet spot. EMD is potentially another sweet spot. Very strong Sharpe ratios for EM corporates and frontier bonds over the last 10 years. I think only global high yield has a better Sharpe ratio over that period. And at the moment with the EM, I think there is some really good structural positives to the market. There's some very attractive real yields available in a lot of countries. EM countries, they hiked a lot quicker after COVID when inflation was a shock. They didn't believe in the transitory message that a lot of other developed market central banks did. And so they were quicker to hike, they've been quicker to cut. So they are still in a cutting cycle at the moment. So that's very supportive to a lot of the bonds. And also a lot of the countries within emerging markets, they're benefiting from the rising commodity prices, like metals and mining, etc. So that's really supportive to the sort of GDP creation of these countries. So there's a really positive fiscal and monetary policy aspect to emerging markets. And yes, evaluations in those regions, they have got richer, or they have more expensive, like the rest of the market over the last couple of years. And you're right, last year performance in EM was particularly good. However, I think there's more room to go in those areas for the reasons I've just outlined, rather than say standard developed market high yield and developed market IG in terms of a spread discipline. So yeah, EM, we're very constructive on EM, and that's local currency, frontier, hard currency, and also corporates. I think they've all got characteristics that could be rewarded over the next sort of 12 to 18 months.